Hey there. Ready to dive into some investment opportunities for 2025? The kind that could have you beating the market for years.
I'm ready.
Okay, great. So, the Motley Fool, those finance folks, they want to make the world smarter, happier, and richer. Right. Well, they released their top ETF picks for February 2025.
We're going to break them down.
That's right, we are. So, we're talking ETFs, right? Exchange traded funds.
Basically like baskets of stocks, all prepackaged. So instead of buying, individual companies, you can buy an ETF that tracks a whole sector.
Like one-stop shopping for your portfolio.
Yeah, exactly.
And what's cool? The guy who wrote the Motley Fool article, Matt Frankel, he actually owns shares in some of these ETFs he's recommending.
Putting his money where his mouth is.
Right. Shows he really believes in these picks. Okay, so let's get into it. We've got 3 specific ETFs. The Vanguard Financials ETF, ticker symbol VFH. Then there's the Vanguard Russell 2000 ETF, ticker symbol VTWO. And then the ARK Autonomous Technology and Robotics ETF. That's ARKQ.
So first up, let's talk about that VFH. Focuses on the financial sector, right?
Right. And Frankel's, predicting this boom in the financial sector in the coming years. Sees a couple of key factors that are going to drive that growth.
Really? What are those factors?
Well, he points to falling interest rates.
Oh.
You remember back in 2022, 2023, interest rates were going through the roof, and it really squeezed banks' profits,
Yeah, makes sense.
When the interest that they pay on deposits rises faster than the interest they earn on loans, margins take a hit.
Higher costs, lower income.
Yeah, not good. But as rates fall, that whole dynamic flips, potentially a surge in bank profits. So it's like a seesaw. Rates up, profits down, rates down, profits up. Okay, so that's one factor. What's the other tailwind that Frankel sees for the financial sector?
Second big factor, deregulation. The new administration seems to favor a lighter touch when it comes to, regulating these financial institutions. Could be good for the whole industry.
Less red tape, more freedom. I can see that being beneficial.
Right. And on top of that, we got to think about President Trump's campaign promise. You remember that? A 15% corporate tax rate?
Mm-hmm.
Most banks right now, they're paying well over 20%. That tax cut, that could be huge for them.
Wow, that's a substantial difference. Okay, so we're talking about the financial sector broadly, but what kinds of companies are actually in this VFH ETF? Give us the rundown.
Okay, so the VFH ETF, it's tracking an index of over 400 financial stocks. We're talking the heavy hitters. JPMorgan Chase, Berkshire Hathaway, MasterCard, Visa, Bank of America.
Big names.
Big names, the ones you see on those skyscrapers,
Giants of finance, all in one package. Sounds impressive. All right, so let's move on to our next ETF, VTWO, which focuses on small cap stocks.
Now, this is where it gets really interesting. Frankel is super bullish on VTWO, calls it his top ETF pick for 2025. He's been aggressively buying shares himself.
Aggressively? He must really believe in it. So what's got him so excited about small cap stocks?
Well, it comes down to valuation. Small cap stocks, meaning companies with smaller market caps, right? They're currently trading at a discount, compared to large cap stocks, the ones in the S&P 500, for example.
Hold on. For those of us who aren't fluent in Wall Street jargon, what exactly does market capitalization mean?
It's a fancy way of saying a company's total value. So you calculate it by multiplying the company's share price by the number of shares they have outstanding.
Okay, so a company with a high share price and lots of shares has a large market cap, and that makes them large cap stock.
Exactly.
Yeah.
Small cap stocks are the ones with, smaller market caps, often younger, growing companies. They haven't reached the size of those behemoths in the S&P 500.
Got it. Okay, smaller companies but trading at a discount. That sounds promising. But why are they so cheap compared to the big guys?
Well, that's the million-dollar question.
Yeah.
There are a few potential reasons, right? Smaller companies, sometimes they're perceived as riskier, or maybe they don't have that brand recognition. But Frankel, he thinks there's a historical precedent here, something to pay attention to.
A historical precedent. Tell me more.
Back in the late 1990s, we saw this similar valuation gap, right, between the small caps and the large caps. And guess what? Small caps crushed the market for over a decade afterwards.
Really? So history might repeat itself?
Well, no guarantees in the stock market, right?
Yeah.
But it's a pattern worth considering.
It's like that old saying, buy low, sell high. But why does Frankel think this trend might play out again? What's he seeing?
He believes falling interest rates could be a major catalyst. Small companies, they tend to rely more on debt financing, right?
Okay.
Lower interest rates, that means lower borrowing costs, gives them a bigger boost than those large companies that aren't as reliant on debt.
That's a good point. So it's like they're getting a financial advantage right out of the gate.
Exactly. And then on top of that, remember we talked about deregulation. Well, that could level the playing field a little bit for these smaller companies.
Yes.
Make it easier for them to compete with the giants.
So it's like this perfect storm brewing, favorable valuations, falling interest rates, more relaxed regulations. It's like a launch pad for small cap stocks to take off.
Could be.
Now for our final ETF, we're venturing into the world of AI and robotics with RKQ.
The future.
It does feel a bit futuristic, and honestly, picking individual AI stocks, that feels like trying to predict the future.
It does, yeah. I think even Frankel would admit to that.
How are we supposed to know which companies are going to be like the next Google or Amazon of AI?
Right, it's such a gamble.
It is. So what do we do?
Well, Frankel has a solution. He's recommending this actively managed ETF. It's run by Cathie Wood. She's a rock star tech investor.
Yeah.
Known for, bold bets on these disruptive technologies.
So it's like we're outsourcing the stock ticking to the expert.
Exact.
Sign me up. But what makes this ARKQ ETF different? There are other AI ETFs out there.
Right. So unlike the others that tend to stick to the big, well-known tech players, this one, ARKQ, it digs a little deeper. It includes some companies that are under the radar. They could have massive growth, but, they're not household names yet.
I love that. It's like getting access to those hidden gems, the ones that most investors miss.
Yeah.
So give us a sneak peek. What are some of the companies that we might find in this ETF?
Get your usual suspects, right? Tesla, NVIDIA, Amazon.
Of course.
The ones at the forefront.
Yeah.
But then you've got some lesser-known players, like Kratos Defense and Security. They specialize in unmanned aerial systems and satellite communications. And then there's Teradyne. They make the robots that build all the microchips,
Wow.
It's a cool mix.
That sounds like a really intriguing mix of stability and growth potential. Okay, so we've covered 3 very different ETFs, each with its own unique angle. But before we move on, there's one crucial point Frankel makes. He's not talking about quick flips with these ETFs. He's in it for the long haul.
That's right. Long-term investments.
Yeah.
He really believes in these sectors. And that's a good reminder for any investor, right? It's not about chasing those quick profits. It's about, believing in the story and letting your investments grow over time.
Absolutely. It's like planting a seed and nurturing it, Let it grow into that mighty oak. Patience and faith in the future. That goes a long way when it comes to investing.
I like that analogy.
So what are your initial thoughts on these 3 ETFs? Anything jumping out at you?
Well, they all have their own appeal, right? But what's really interesting to me is how they tap into some of those bigger trends that are shaping the market right now. The financial sector is poised for this potential rebound. Small cap stocks looking like a bargain. And then the rise of AI and robotics, it's unstoppable.
Yeah, it's like a glimpse into the future of finance, right? It's not just about picking individual stocks. It's about understanding the big picture, those underlying currents that drive the market. But, we've only scratched the surface.
Yeah.
There's a lot more to explore. We've got to unpack each of these ETFs a bit further. We've talked about their potential, but what about the risks? Every investment has a flip side.
Definitely.
So what are some of the potential downsides? What should we be aware of?
It's fascinating to me how these ETFs, they seem different, right? Financials, small caps, AI. But they could all be connected in ways we might not realize right away.
Oh, interesting. How so?
Well, imagine Frankel's prediction about falling interest rates. Let's just say it happens. It could create like a ripple effect across the whole market.
Well, effective, I'm listening.
Lower interest rates.
Yes.
They tend to stimulate economic growth.
Right.
And that growth could provide a tailwind for small cap companies, but it also, fuels innovation in AI and robotics.
Yeah.
They're all connected in this like intricate web.
Ah, I see. It's like a chain reaction. One sector's success feeds into another. It makes you wonder if there are even more connections, hidden connections between these ETFs.
Exactly. That's the beauty of investing. It's not always about picking the obvious winners. It's about understanding how different sectors, how they influence each other, how they rise and fall together.
It's like a dance.
Yeah.
Okay, I'm starting to see the bigger picture, but let's zoom back in for a second. Unpack these ETFs a little more. We've talked about the potential, right? But what about the risks? Every investment has a flip side, right?
Oh, yeah.
So what are some potential downsides with VFH, that financial sector ETF?
Well, you hit the nail on the head, right? Every investment, it comes with risks. And with VFH, one of the big concerns is, unexpected economic shocks. Remember 2008, the banking crisis? Financial institutions, they often feel the pain first when the economy takes a hit.
That's true. So even with less regulation, a major economic downturn could still, rock the financial sector.
Oh, yeah. Those banks and VFH wouldn't be immune.
And even with the falling interest rates, that might boost profits initially, but isn't there, a tipping point?
There is. If rates stay too low for too long, it can actually start to hurt their profitability. It's delicate.
They need that Goldilocks zone.
Exactly. Not too high, not too low.
Just right. Otherwise, profits could take a hit.
Right. And then there's another risk to think about. Competition. Specifically, those fintech companies.
Fintech, you mean like the startups that are shaking things up?
Exactly. Those guys. They're nimble, they're innovative, and they don't have all the legacy systems and the regulations that the traditional banks have to deal with.
That's true. It's like the old guard versus the new kids on the block.
That's what it is.
Innovation can be, it can be good and bad. It can drive growth, but it can also disrupt things.
For sure. Okay, let's shift gears. Let's talk about VTWO, the Russell 2000 ETF. One of the biggest risks with small cap stocks, just in general, is their volatility.
Volatility, meaning, explain it to me.
Basically, their prices tend to swing a lot more up and down, but much more than large cap stocks.
Yeah.
They're more sensitive to, market swings and economic headwinds, like a roller coaster.
So if you don't like roller coasters, maybe not the best ETF for you.
Probably not. But the flip side is that volatility. It also means there's potential for bigger returns.
Yeah.
It's all about, how much risk you're comfortable with.
High risk, high reward. Okay, but what about specific risks with the Russell 2000?
Well, remember Frankel's whole argument about the valuation gap between the small caps and the large caps. There's no guarantee that that gap will close or that small caps will do better because of it. It's a bet on history repeating itself.
Right, and history doesn't always do that. Plus, even if small caps do outperform, who knows how long it'll take? Patience is key.
Always. And lastly, let's talk about ARKQ, that AI and robotics ETF. This one's all about, cutting-edge tech, rapid innovation, and potentially massive disruption.
Yeah, it's exciting and a little scary all at the same time. What could go wrong in the world of AI and robotics?
Well, one big risk is the speed of change. It's so fast. What's revolutionary today, it could be obsolete tomorrow. It's a constantly evolving landscape.
It's like trying to hit a moving target.
Yeah. Makes it super difficult to pick the winners and losers. High stakes, a lot of unknowns.
Which is probably why Frankel went with that actively managed ETF, right? He's trusting Cathie Wood's expertise to, navigate those waters.
Right, but even with a skilled manager, there's no guarantee. And actively managed ETFs, they usually come with higher fees. And there's always that risk,
Yeah.
The manager might make the wrong call.
True. There's no such thing as a risk-free investment.
Nope. Now, one more risk with ARKQ specifically is, its focus is pretty narrow, concentrated in a single sector.
So diversification, or the lack of it, is a factor here.
It is. If that AI and robotics sector takes a hit, this ETF could feel it more than a broader market ETF.
Right. It all comes back to understanding the trade-offs. Potential reward versus potential risk.
Exactly.
This has been a lot to take in. We've explored the potential benefits, the risks of these three ETFs. It's crucial to, just pause and reflect on what we've learned. It really highlights the importance of doing your own research,
Oh, absolutely. Can't stress that enough. It's not enough to just take someone's word for it, even if it's, a source you respect, like the Motley Fool.
Right. You've got to dig deeper. Understand what you're actually investing in, why you're doing it, and the potential downsides, too.
Yeah, that's how you make smart decisions. Ones that, line up with your goals and your risk tolerance.
Like anything else, right? The more you know, the better choices you can make. So as we wrap up this deep dive into these three ETFs, what are some key takeaways for our listeners?
Well, first and foremost, never forget, every investment has some risk.
Yeah, there's no such thing as a guaranteed return, right?
Right. Things can go down as well as up.
It's like the golden rule of investing, right? Don't put in what you can't afford to lose.
Exactly.
Yeah.
And secondly, think about your own risk tolerance. Are you okay with those, wild swings that small cap stocks can have? Do you want to bet on AI and robotics? Those are questions you got to answer for yourself.
And there's no right or wrong answer. It's about what's right for you.
Exactly. Third, don't forget diversification.
Oh, that's a big one.
Spread your investments around, different asset classes, different sectors. That can help lower your risk. Don't put all your eggs in one basket.
Words to live by. So it's about building a balanced portfolio, right? Something that can handle the ups and downs, but still capture those growth opportunities.
That's it. And lastly, remember, investing It's a long game.
It is.
Don't get caught up in those, day-to-day market jitters.
Stay focused.
Yeah. Build a solid strategy and stick to it.
Patience and discipline.
Exactly.
Yeah.
And sometimes the best investment you can make is investing in your own knowledge. Learn about the financial world.
The more you learn, the better decisions you make.
Right. Knowledge is power, especially when it comes to investing.
So there you have it, our deep dive into 3 potentially lucrative ETFs for 2025. We talked about the upsides, the downsides, all that good stuff. Now it's up to you to take this information and, do your own homework.
Right. This is just a starting point.
Yeah.
Do your research, explore, and make those decisions that are right for you.
Happy investing, everyone.